Hey there, awesome accounting student. Mark Franke here. This is video for Accounting 100 on Chapter 12. And we are going to talk first about two words, deferral and accrual. These are very important concepts for accountants because we want to make sure that when we prepare financial statements, they're properly adjusted for deferrals and accruals. So let's talk for a second about what these words mean. Deferral means to push it into the future. So both of these concepts can be either a revenue or an expense. But to push something into the future means that we're going to record the revenue in the future. We're going to record the expenses in the future. From a revenue standpoint, if someone pays us money, a customer pays us money in advance, it creates a liability because we haven't done the work yet. For example, if we buy season tickets to the Lakers, or if we buy a ticket to a concert in the future for the Rolling Stones or something like that, from the standpoint of the Lakers or the Rolling Stones, when they receive your money in advance, they have a liability. They have to either perform the concert, play the basketball games, or give you your money back. So that is deferring the revenue until they actually do the work. And that liability is called unearned revenue. From an expense standpoint, if we pay money in advance to get insurance or for rent that we pay for a future period of time, that's an asset. It's a prepaid expense that we are going to use in the future. So we have to then think about if any of these things have now been earned or if any of those expenses have now been incurred that we would need to make an adjustment. The word accrual means to pull it into the present, reach into the future, pull it into the present. And this is, for an example, when we do the work and we just haven't been paid by a customer yet, well, we're going to accrue the revenue. If we've mowed the lawns or if we've cleaned the pools or whatever it is that we do to earn money or ship the goods, if we're in a merchandising business. If we've done everything we need to do, we can record that revenue even though we haven't gotten paid for it. We will get paid from the customer in the future, and that is called accounts receivable. That's an asset. On the other side, if we incur a liability because somebody comes and does some work for us. We hire a programmer to come in and program our computers, right? And then when he or she's done, they send us a bill. That's a liability. They've already done the work. From our standpoint, we receive the benefit of them programming our computers, and so we have to create a liability called accounts payable. But it could be salaries payable, it could be a number of things. So what I'm going to do is go through problem 12.5b. This is on page 423 in your textbook. This is Whatnots, a retail seller of cards, novelty items, and business products. So what they've done is they've given us a trial balance, and I've got that on a worksheet. And by the way, there's worksheets for you to use. But before we get to the worksheet, we need to do some adjusting journal entries to do accruals and deferrals. The very first one is A and B, and it says that merchandise inventory on hand at December 31 is $15,840. What that means is they physically went out and counted the inventory, and they had $15,840 sitting in their store, their warehouse, whatever it is. Their probably store. These are novelty items, but whatever it is, it doesn't matter. We counted it and it's there. So we know we didn't sell it yet. How do we know that? We still have it. But the stuff that was there at the beginning of the year is gone. It's been sold. So we need to write off the stuff that was there at the beginning of the year. And how are we going to get that? It's still sitting on the trial balance. If you look at the trial balance under merchandise inventory, you'll see there's $16,985 that was there at the beginning of the year. It's gone. So we're going to debit the income summary and credit merchandise inventory. That's entry A. But for entry B, we're going to do the opposite because the stuff we counted at the end of the year now has to be recorded into the general ledger. So we will debit merchandise inventory, which makes inventory go up. Merchandise inventory is an asset. And then we credit income summary. So that in the income summary account, we basically have the difference of these two amounts. And when we get to the worksheet, you'll see how that works. Entry C, and by the way, feel free to pause the video so you can write these out. I decided I would just present these already typed out so I could talk more about how they work rather than just spend time typing. Entry C is we are accruing for an expense for customers who we don't think will pay us. This is uncollectible accounts expense, right? So we have credit sales of $160,000, and they've estimated that 0.8% is not going to be collected. This is a business decision. We sometimes extend credit in our business to customers who may not pay us. And so we have an expense here. So we calculate this by taking the credit sales times 0.8%, which is $1,280, and we debit $1,280 to uncollectible accounts expense. We're recording an expense, and we credit allowance for doubtful accounts. We are accruing for the expense that relates to customers who we don't think will pay us. It's an estimate. It's based on historically how that works. Now, 0.8% is a very low percentage, so that's probably good. It means that we had a lot of sales that to people that we may not have even gotten sales to if we didn't extend credit. Entry D. We had some supplies. In fact, the balance in the supplies account says we have $750 worth of supplies, but we went out and counted the supplies at the end of the year, and we found out there's only $245 worth of supplies left. So we have to write off what we used, which is the difference between how much we bought and how much we still had left over, $505, debit supplies expense, and credit supplies. Supplies is an asset, so when we credit this account, it will go down. We want it to end up at $245. Entry E. We bought an insurance policy. We bought a 12-month policy for $2,400. The math is easy. It means that $200 is the monthly expense for that insurance. They told us that we bought it on July 1st, so we're now at December 31st. We have July, August, September, October, November, and December, 6 months to write off because they have expired, and that's $1,200. Debit insurance expense. Debit expenses are always debits. And credit prepaid insurance. That's going to make prepaid insurance go down. Prepaid insurance is an asset. It goes down with a credit. All right, I'm going to go on to page 2, journal page 2. This is transaction F. And transaction F is related to our store equipment. We originally bought $6,000 worth of store equipment. We estimate that when we're done at the end of 5 years, we'll be able to sell this equipment for $1,000. It's an estimate. How do we know? This is just based on either stuff we've done in the past, or maybe the vendor we bought the equipment from said, oh, if you use this for 5 years and you don't abuse it, it'll be worth $1,000. Whatever it is an estimate. It may or may not be exactly $1,000. It probably won't be, but it's still an estimate. We have estimates in accounting. Our total depreciation then for that 5-year period is $5,000. Our useful life is 5 years, so we're going to write off $1,000 worth of the cost of that equipment. And as you learned back in chapter 4, maybe 5, we debit depreciation expense on the store equipment, $1,000, and we credit accumulated depreciation on the store equipment, $1,000. Accumulated depreciation is a contra asset. It is tied together with store equipment. We have the same entry for G. G is just the store fixtures. Somehow we've identified store fixtures as being different than store equipment. The fixtures, maybe that's the lighting or racking or whatever it is, but we have a separate asset category called store fixtures. The original cost of that was $15,760. We deduct the estimated salvage value, and so our total depreciation on these fixtures is $14,350 divided by a 7-year useful life. So the annual depreciation for that is $2,050. Debit depreciation expense on store fixtures and credit accumulated depreciation store fixtures. The reason we've identified these differently is because they have a longer useful life. If they had a 5-year life, we could probably just lump them together with our store equipment, but for whatever reason, we've identified these as a separate category, and that's fine. Transaction or journal entry, adjusting entry H is interest. We hold a note payable to a bank. We borrowed some money from the bank, a measly $4,000, and we're paying 9% interest per year on that. Interest rates are always annual. So when we take the $4,000 times the 9%, we get annual interest of $360. We held this note for 3 months, which is a quarter of a year. 3 months, October, November, December, that's 25% of a year. So the amount of interest that we need to accrue is $90. Debit interest expense, $90, and credit interest payable, $90. And then our last couple of adjustments relate to payroll. We had employees that worked for us that we haven't paid yet. So we will, but as of 12/31, as of midnight on 12/31, we hadn't paid these people. And so we have 2 adjusting entries that we need to make. One to accrue the salaries, and the next is to accrue the payroll taxes that relate to those salaries. So they told us there was $1,450 worth of salaries that were unpaid. And again, these are for people that worked during December, but we just hadn't paid them yet as of December 31st. $1,450 debit salaries expense, credit salaries payable. $1,450 salaries payable is a liability. Liabilities go up with a credit. That's so it's going to go up. Payables are always liabilities, including the payroll tax expense liabilities for Social Security tax, Medicare tax, FUTA tax, and SUTA tax. We learned about these in chapter 9, I believe, or 10. Not 10, sorry, chapter 10. So when we add those 4 taxes up, these are the 4 taxes that we have as an employer. It's $192, debit payroll tax expense, $192, and credit each of these individual payable accounts. So those are the adjustments A through K that we're going to use. And I'll stop the video here. And just to give you time, you can handwrite these out, or you can do them in Excel, and you can upload them into Canvas for the points. And then I'll have another video where we'll post these entries to the worksheet and balance out the worksheet. All right, so thanks for listening, and I'll see you soon. Bye-bye.